Muted.
I'm joined by Jim Cumbee, Managing Director of Tennessee Valley Group, where he helps owners of good businesses make great exits. Jim is a successful entrepreneur, having bought a business out of bankruptcy and then turning it around and sold it as a publicly traded company. Jim is also an attorney, and he has an MBA from Harvard Business School. He has over 30 years of experience in building and selling businesses. Jim, if you're ready, I will hand it over to you.
Well, thank you, Julie, and good morning, everyone. I appreciate that introduction. I didn't sell my company as a publicly traded company. I sold it to a publicly traded company. So I just want to be clear about that. So we're going to talk today about the 6 principles of making your company irresistible before you decide to sell it. Now, even if you're not thinking about selling your business, I think the information we're going to talk about will be important to you. Now, at the risk of getting off on a bad foot, I'm going to start with some bad news for you all. Think of this as a stomach punch. Your exit from your business is inevitable. All that's uncertain is what will trigger your exit. Now, here's the really tough news. You are not likely the one to pull the trigger on your exit. Now, what do I mean by that? Only about 25% of the businesses that we see traded are exited on a controlled basis. And by that I mean the owner has made the decision. And there are really 2 kinds of controlled exits. Number 1, retirement. Business owner makes a decision to retire, goes out and finds a buyer, whether the buyer is an employee, key customer, whatever the case may be. But retirement is certainly a trigger for selling. The other trigger for selling is opportunity. Julie made mention of the fact that I had a business several years ago. I had a radio business, and in the course of my ownership, Congress deregulated radio ownership laws, and my station value suddenly became more valuable, and I started getting a lot of suitors at my front door. So I took advantage of an opportunity. But what I'm here to tell you this morning is only 25% of the business exits are done on a controlled basis. The other 75% are done on an uncontrolled basis. Now, I know you all are thinking, I'll be part of the 25%, but let's just assume statistically that you've only got a 1 in 4 chance of a controlled exit. So what does an uncontrolled exit look like? I'll put these in the form of 5 Ds. Divorce, a disagreement with a partner or a key employee. Distress, obviously, is a reason a lot of businesses are sold. Detachment. And by detachment, I mean a business owner just sort of gets bored with his or her business and just wants to go do something else. And of course, the final D is death. Now, I want you all to know, if you could look at my calendar, I do a lot of business transactions, do a lot of advisory work around the Tennessee Valley. These are exactly the reasons I talk to business owners every day. And while everybody thinks they're going to be on the left side of the screen, the controlled exit, I'm telling you statistically, 3 of 4 exits are uncontrolled and happen because of one of these 5 Ds. So that really sets up the key thought for the day and why you're all here. Since you will likely not control the timing of your exit, my counsel to you today is to get ready now, to be irresistibly ready when that time comes. Let me repeat. Since you are statistically not likely to control the timing of your exit, my advice is that you get ready now to be irresistibly ready when that time comes. Now, what do I mean by get ready? There's really 2 components of getting ready. Number 1, know how your business is valued. And that's a series of quantitative factors, which we'll look at it here in just a second. But the other thing you need to do to get ready is know how your business will be perceived. And these are really the basis of the qualitative factors, which I call irresistibility. So let's start with the quantitative piece. Now, this is a subject matter that we could talk about for a couple of hours, and I'm going to give you a really, really high-level 35,000-foot view evaluation. But you all know instinctively that business values are a function of revenue, rate of growth, and profitability. And it all kind of comes down to The common shorthand is a multiple of your EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Now, let's think about a multiple on a continuum, higher multiple to lower multiple. So for purposes of this conversation, let's look at three companies. I've got a $5 million revenue business that makes $750,000 a year. Now, if I didn't know anything else about the company, if that's all I knew, I might be inclined to give it a 4x multiple and say the business is worth $3 million. Okay, let's look at another business. This business is at $2.5 million of revenue, and it is certainly less profitable. It only makes $125,000 a year. Again, if I knew nothing other than that, I might be inclined to give it a 3x on the EBITDA. On the other hand, I've got a business that has a higher revenue, $8 million, and certainly more profitable. They make $2,225,000. Again, if I knew nothing else about the business, I'd be inclined to give it a 6x multiple, 6 times EBITDA, which in this case would be $14 million. So that's what I mean by the quantitative factor, just kind of getting a shorthand view of how your business measures up on the numbers. But I know what you're probably thinking about this point. If you're probably all kind of processing in the back of your heads, what is my business worth relative to these factors that Cumbee just told me about? But I'll tell you that the better question really is, what makes my company more valuable and hence easier to sell? And that's what we're going to talk about now, the 6 principles of irresistibility. The first principle is a diverse customer base. Now, a diverse customer base is less risky because the business is less likely to see wide swings or spikes in revenue. In an ideal world, your largest customer should not represent more than 15% of your total revenue. Now think of it this way. Let's say you have 2 companies, each with $5 million in revenue. One company has 5 customers of $1 million each, and the other company has 20 customers of $50,000 each. I would tell you that the latter company is less risky and hence more valuable. A diverse customer base is the same principle as a diversified stock portfolio. You don't want to have all of your wealth tied up in 1 or 2 investments. Similarly, you do not want to have your business revenue tied up in a limited number of customers. Secondly, a durable revenue stream, also sometimes referred to as recurring revenue. Now, durable revenue means your customer does not have to be resold every month. Perhaps the best example is your cable service. You make one decision which service you want, it's installed, then you pay the fee every month. The cable company doesn't have to come out and resell you every month. Now, I told you earlier I had a radio business. We delivered radio programming to radio stations via satellite. This is before the internet, via satellite. And once a radio station paid us a flat fee every month to use our programming. So when the buyer showed up at my door to look at my business, they saw a predictable and durable revenue stream. Another example many of you might be familiar with is Harry's, which sends razor blades on a predefined schedule. For example, I get 12 new blades every 3 months. The point being, if your company has some kind of recurring revenue, it will be perceived as less risky and hence more valuable. Dependable financial statements. 90% of the companies I work with only have compiled financials, which is a simple organization basically of your general ledger. But when it comes time to sell your company, it will be seen as more valuable if you have a higher quality of financial statements, such as audited or reviewed. Now, I'm not a CPA, so I'll give you a very high-level overview of these 2 methodologies. Audited financials are the most expensive, yet the most comprehensive. Reviewed financials are becoming more accepted by buyers because reviewed financials offer a higher level of authenticity than compiled financials, though not as complete as an audited financial. Now, again, we could spend a lot of time really digging into the definitions of audited and reviewed and compiled. I would just encourage you to get with your accountant to discuss the pros and cons. But I will say with that reservation, if and when you're ready to sell your company, having reviewed or audited financials will make your company more valuable to a buyer. Next, demonstrable margin improvement. Now, this means you grow revenue. As you grow revenue, you're getting relatively more profitable. Another word for this you might often hear is scalability. Now, some people assume a company is only valuable if it's growing fast, but that is only half the formula. If you can show that as you grow, you are becoming more profitable, your business value will increase. Next factor of irresistibility, a distinctive angle. What makes your company special? I'm not talking about good customer service or friendly employees. Those kind of factors are now norms for all businesses. But what makes you really special in the marketplace? I once sold a wine distribution business that had agreements to sell some of California's most premium brands, and that gave my client a distinct edge when talking to potential buyers. I was recently working with a commercial printing company, and you can't get much more generic than commercial printing, but these guys had developed an innovative sales model that made them more profitable than the industry averages, and that distinctive sales process was very important to our potential buyers. And finally, a defensible business model, one that's not over-reliant on the owner. The simple question is, how important are you to the business's daily success? Hopefully, the less, the better. Of course, the owner of the business has to set the strategy and create the culture, but the business will be more valuable if it can operate without the owner's active daily involvement. I have a friend who owns a company, and he just returned from a 2-week trip to Italy, and he was telling me that he didn't check email or make calls to the office while he was gone, and when he got back, his desk was not a mess of things to do. My friend's business success is not dependent on his daily activities, and this factor is important to a potential buyer because a buyer doesn't want to buy your company, then see it fall apart when you walk out the door. Now, let's try to put all this together. Let's go back to our quantitative factors. I told you that if I knew nothing else about this $5 million company with $750,000 worth of EBITDA, I would give it a 4x multiple. But based on how they might size up against these qualitative factors, it really might be worth just a 2x multiple. At the same time, this company over to the right, the $8 million company, might be a lot more valuable than you would think just on the quantitative factors because they address more of these issues of irresistibility. So I know 13 minutes into it, I've given you a lot of information, and you all are probably saying, what do I do now? I'd give you this advice. Number one, estimate your current value. And when I say estimate, just kind of go back to the shorthand I gave you and get a sense of how you think your business sizes up. The next thing you need to do is, if you have a wealth planner, sit down with him or her and help them help you define your financial objective. What do you want to get from your business? Now, again, I'm not saying you have to even have selling your business in sight, but at some point you want to exit. What do you want from that business at the point of your exit? Now, let me give you an example. Let's assume you sit down and you do your backhand evaluation and you think your business is worth $6 million. Then you've met with your financial planner and they have told you that you really need $9 million to achieve whatever objective you have. Well, that means you've got a gap of $3 million, right? You've got a $3 million gap. Well, that $3 million gap defines your scope of work. And that scope of work comes back to the 6 principles of irresistibility. I would pick 1, 2, 3, 4, however you think you might rank on each of these, and along with the other just normal processes of running your business, make one or more of these a project, and that to address these issues, and that makes you qualitatively more likely to sell your company and achieve a higher valuation when that time comes. Now, let's review what we've learned today, and then we'll wrap up and I'll take questions. The exit from your business is not likely to be when and how you expect. Therefore, get ready now, know your gap, and focus on the 6 principles of irresistibility. So I would say good luck and God bless, and I'll be happy to take your questions.
All right. Thank you, Jim. As far as questions, so I actually had one of the 6 principles that you mentioned of irresistibility, which would you say is probably the most important?
Well, I would tell you that when I meet with buyers on behalf of clients who are selling their company, a buyer will almost always ask early in the conversation about the diversity of the customer base. It just seems a lot of small businesses, I say small businesses, say under 20 million in revenue, the customer base is not as diverse as it can be or should be, and that creates a very high risk for a buyer. So I would say that if you're going to rank these and you felt like you needed to work on all of them, I would make that one pretty high on the list of objectives to diversify the customer base.
Okay, thank you very much. We've also had a question here from Valerie, and she's asked if you could please talk a little bit more about that distinctive angle in those 6 principles.
Well, that is a tough one, Valerie, because it's very hard for a business owner to sit down and look at his or her business and say, this is why I'm really special. But let's look at the commercial printing company as another example. As an example, I'll go a little bit deeper in that. This is a very profitable company, really well-run company. It had all the factors going for it that you would want: good team, good diverse customer base, everything. There was no red flag in the deal. But as I was talking to private equity investors, to private equity buyers, they kept wanting to know what was special about the company. And I would say, well, it's special because it has a 20% profit margin. It's special because it's growing revenue at 9% a year. And I would always kind of revert to the quantitative factors to define what made it special. And they continued to say, well, what makes it different? I mean, we want to have a company that's unique in the marketplace, has a unique angle. And that's really what I mean by distinctive angle. And I really, frankly, had to work with the business owner over several weeks to really figure out that what was driving his success was this unique sales model that he had. And that's what we began to talk about, the distinctive angle. So there's something in your business that makes it a little unique, a little different, relative to your competitors. And I would really focus on that. But again, don't get wrapped up in believing it's just about, we treat our customers right, or we have business principles, high integrity. Those are all good things, obviously, but those are, in this market environment, those are the expected things. So what's distinctive about your business that would be perceived by a buyer to be unique?
Okay, thank you. Matthew has asked, what evidence does a buyer look for that shows the business is not overly reliant on the owner?
That's a great question, Matthew. I use the example of my friend who just got back from a 2-week vacation. Sometimes it can be just like that you can say, what I have found myself in meetings with buyers and sellers, the buyer will ask questions about how active is the business owner. When do you come in? I mean, how many vacations do you take? What processes get your approval? And then the other thing, as you get further into the conversation with the buyer, they will at some point in the conversation want to talk to your key employees. And sometimes the key employees can reinforce that message. Well, Bob owns the company, but we don't see him much, and we don't have to run this major decisions by him. And it's very much a qualitative consideration. I can't reduce it to a checklist of things. But if the reason I use the example of my friend who went to Italy, that literally can be a great example to say we are away from the business. We do these things. I've got these other areas of involvement. But it really revolves around, are the customers reliant on the business owner, and are the employee decision making reliant on the owner? And those are the two things that will be looked at pretty carefully.
Okay. And Dave has asked, most business owners think that their business is worth more than they are. And how often do you find that business owners are underestimating the value of their business? And when you see that, why might they be underestimating? Excuse me.
You know, Dave, I do see that. It's interesting, and that's why I really would counsel you all to get a handle on your valuation based on the metrics that I've talked about, because owners tend to fall in one of two camps. Either they overvalue their business or they undervalue their business. And my conclusion after working in this for 20-some years, I'm not a psychiatrist, but I think in trying to understand owner mentality, and I'm going to be a little harsh here when I say this. I think in some respects the owner doesn't like his or her business. They've gotten tired of it. They're frustrated, and therefore they think, well, who would want this? You know, who wants the problems I have? But you know, every man's, what's the saying? You know, there's always a buyer and a seller, and but I think that oftentimes the reason people overvalue companies is because they use the wrong metrics. They think of their business like a publicly traded company, and those metrics are not applicable to privately held businesses. Or they base their valuation on what they think they need for retirement, which is fine. I don't have a problem with that. But that's what I call the gap. You don't, if you need $9 million and your business is worth $6 million, don't just assume you're going to sell your business for $9 million. You have to do these things to move your business to therefore be more valuable. But it is interesting to me, having worked with scores and scores of business owners, they tend to fall in one of the two camps. Either they undervalue their business or they overvalue it.
And Tom has asked, what do you see as the typical hurdle for most business owners to make this move and address their gap and or weaknesses? For example, the emotional hurdles, can't make time because of working on versus in business, and the business being too reliant on an owner.
Well, that's exactly right, Tom. You've kind of answered your own question, that it becomes a self-fulfilling prophecy. If you're invested in the company every day, and decisions can't be made without you, and customers are coming to you, and suppliers are coming to you, it's very hard to unwind from that. And that's why this message, I think, is so important, because none of these 6 factors are necessarily easy to do. Maybe the dependable financial statements can be done reasonably quickly, maybe 6 months or less. But these other things take some time to evolve. So I think being able to remove yourself from the day-to-day business. Who wrote the E-Myth? You all probably heard of the book, The E-Myth, by Michael Gerber. He coined the term working on your business, not in your business. And that is a euphemism for just not being over-reliant on the owner. But I fully recognize it's much easier said than done when you're on the firing lines every day.
Okay, thank you. And John has asked, he has a small company of $250,000 in annual sales, but a 42% profit margin. Is it realistic to sell given the size?
Sure. Every seller, there's a buyer out there somewhere. I still think the buyer at that level is not going to be a sophisticated private equity investor, but interestingly enough, John, I think the buyer will ask the same questions that you see on this slide. They may not do it quite with the level of precision and structure that I've given it to you, but these factors are still the factors that a business buyer is going to think through as they look at your business. I don't want you to think that these principles only apply if you're over $10 million or whatever. These principles apply at any level of transaction.
And Jan has asked if you could please describe some examples of margin improvement.
Yes. I should have maybe done that in the presentation, Jan. the let me tell you. Okay, let's go back to my radio company. So here I have radio programming produced here in Nashville. I put it up on a satellite, and there's a lot of fixed cost to program 24 hours a day, 7 days a week, and put it on a satellite, right? There's fixed cost. So every customer I add, every time I add a customer, the profit for that customer goes up because I'm not spending any more fixed costs to get that customer. So that's one example. The printing company I was telling you about, you know, if they do $9 million in revenue or $10 million in revenue, that $10 million will be more profitable than the 9 because they're not adding any fixed cost to go from $9 to $10 million. So really, it's leveraging fixed cost, or it's being more efficient in maybe your materials. Back to my printing company, if they were doing 15 million in revenue, they would be buying more paper, right? Well, if you're buying more paper, you should be able to get more terms on better terms on the paper that you buy, the raw materials. So it's really a function of how you leverage your growth to be more profitable. And so growth alone, the key message is growth alone is not the story. It's can you be more profitable as you grow.
Okay, and Dave had another question. If a business owner wants to get a more formal valuation of their business, is there a tool that you recommend that they can do that?
Well, you know, I've seen a lot of apps and tools out there. I kind of don't know why. If you need a formal valuation for some process, like an estate issue, or maybe sometimes going through divorce, it requires a formal valuation, then you need to go to a CPA who does valuations. But if it just comes to kind of the shorthand we've talked about, I don't think there's anything out there that really that is going to be a whole lot better than what you can do in the back of an envelope, like I've talked about here. So it kind of depends on the real driving reason to get a valuation, unless you have to for some sort of legal process. I don't think there's anything better than just kind of looking at your business and making some estimates kind of along this 2 to 4 to 6 times EBITDA continuum.
Okay, and Jerry has asked if you could expand a little bit on why you consider detachment as an uncontrolled factor versus controlled. He gives the example of saying, don't I have control, realizing that I have a thriving business, not getting the same out of it. He just wanted you to expand on that a little.
Well, I wanted to get my 5 Ds, Jerry, so maybe that's one reason I used the word detachment. I think the reason I called it uncontrolled is that wasn't what the owner expected when he or she started the business. They didn't think that, most of you think, as I thought, that I started this, in my case I bought a business, and I bought this business and I'm going to sell it either under, I'm going to make a lot of money and some opportunity will come knocking, or I'll own it until I'm ready to retire, and then I'll back away from it. The reason I put detachment under uncontrolled, I don't think anybody expects to get bored with their business. They don't expect to find their business is a drag on their life, and that's really why I put it in the uncontrolled. You're right. I mean, obviously, we can talk about the definition. If you get a divorce, it doesn't mean you have to sell your business. So therefore, you perhaps can argue that you controlled your exit. But I'm just talking about the factors, the external factors that drive your decision to sell are more times than not factors that are positives in your life. And I think that's the essence of the 5 Ds. These are factors that by and large you didn't see coming, you didn't want happen, you didn't choose them to happen. They happened to you for reasons you didn't want or you didn't see coming. So that's why I called them uncontrolled.
Okay, and Jeff has asked you to comment on, he had been told that when selling a privately held business, you need to restate the financials for potential buyers.
Yes, and again, that could, Julie, you ought to put that on the list of another webinar because that's the whole topic into itself. But Jerry, what the word restatement means is going back through your business and looking at all the expenses that might be optional that a buyer wouldn't have. For example, I work with business owners a lot who might have a country club membership that they run through their business. It's a perfectly legal expense from an IRS standpoint, but they can add that back in because they a buyer, that's a discretionary expense. It's not necessary to the maintenance of the business. Oftentimes, business owners will run cars for their spouses or children through a business. Again, those are discretionary expenses. So the word restatement of financial the restatement of financial records is really about pulling out the discretionary expenses and getting to an adjusted EBITDA. I hope that makes sense. You almost have to see some to explain it. I'm trying to think of some that I've seen recently. Here's another example. I'm selling a company now, and the two owners, the partners, pull out a lot more. They work in the business, but they pull out a lot more from the business than would be required for a CEO. So we take that difference and add it back into the business because a buyer wouldn't have to pay a CEO what these two guys are pulling out every month. So I hope that kind of explains the notion of restatement. But it's basically looking at your business and saying, what are the mandatory expenses to run this business? And then that's how a buyer would look at it.
Okay. And Timothy has asked if you could maybe explain normalized EBITDA versus book EBITDA.
I'm not sure I know what the difference would be. Normalized versus book, Timothy. If you could clarify there on the Q&A form what the difference is.
Okay, so I'll go to another one while we're waiting on that. Tom has asked, given the effort to improve desirability of a company, and while theoretically there is a buyer for every company, some synergistic, some for investment, etc., how long should most owners anticipate it will take to make the company more desirable directionally? And then how long, again directionally, should an owner anticipate it may take to sell the business?
Fair question, Tom. I hear that a lot. I would say that, let me answer the second one first. Once you're teed up and ready to sell, I would tell you that the average is going to be 9 to 12 months. I've seen shorter, I've seen longer, but just think 9 to 12 months. Now, the first part of your question is how long does it take to get your company ready? Well, that might be 5 years, could be 7 years. I mean, if you look at these 6 principles and say, I need to work on all of these, then well, none of these can happen in a matter of months. This is all hard work that takes time. The financial statements are probably the fastest and easiest because that's just a function of what you tell your accountant to do at the end of the year. But these other aspects require, in a lot of cases, a retooling of your business model, and that takes a lot of time. So I would never be able to say that to get your company to a point of irresistibility takes X period of time because I don't know the base from which we start.
And Jan has asked if you can maybe discuss the purchase payment options, if it's all cash, stock, or non-cash, periodic payments, and conditional terms.
I'm going to show you a slide I have here that I kind of halfway expected that question to come up. Let me go back. Right here. I'll answer it this way. And who asked the question, Julie? Who?
It was Jan.
Hey, Dan. Dan, I'll try to answer your question this way. Again, I'm being very general here, but I think this will begin to give you some help. If your business is under $3 million of revenue, you're likely to sell your company to an individual. And if you sell to an individual, you're more times than not, you're going to be required to finance 25 to 40% of that. And there are even some SBA reasons for that. But again, at the risk of being overgeneral, just kind of work from that assumption. If your business is over $3 million in revenue, you're going to be more appealing to a strategic buyer. And a strategic buyer is another company that would buy yours for either purposes of horizontal or vertical integration. And if you sell your company to a strategic buyer, they're more times than not, they're not going to require any seller financing. You're just going to take a cash and be done with it. Now, if you get your company over $5 million of revenue, you're going to be your likely buyer is either a strategic or a financial buyer. When I say financial buyer, for this conversation, I'm going to refer to financial buyers as private equity. Now, more times than not, when you sell to private equity, there'll be a gap between what you want for the company, what you think the company's worth, and what they're willing to pay, and that gap can often be paid out in the form of an earnout, where you stay involved in the company and you get paid some predefined amount based on predefined parameters of your business success. That's referred to as an earnout. So I hope that answers your question. That how the terms by which you sell your company are really a function of the size of the company and who the buyer is.
All right, wonderful. That seems to be all of our questions. So thank you guys very much for asking those. Jim, would you mind to put your perfect? Your contact information is right there. So if you do happen to think of anything else that you didn't get to ask, or if you're going about your day and you think of something else, feel free to reach out to Jim at the contact information on your screen. And you can certainly check out all of our previous BOSS webinars on demand by visiting our website and clicking on the webinar section in the header. And you can also register for our next session, which will be June 15th, and it will be focusing on using LinkedIn strategy to grow your business. Thank you again, everyone, for joining